Alex stared at his banking app in disbelief. This time wasn't like before. He actually had a system now. Money for spending, money for saving, money set aside properly. For the first time in his life, he wasn't randomly burning through cash anymore. And honestly, it felt good. Alex now knew what inflation meant. He'd begun to really noticing the impact of it. Prices went up again? His hot chocolate, up 20 cents, his bread roll before work, up 25 cents. They were small amounts, but they add up, and his wages weren't even moving up at all. Alex's interest earnings were so small, so technically,
My money's still falling behind?
that's the part nobody tells you when you first learn to save. Even when you're disciplined, even when you improve, inflation can still make it feel like you're losing.
I actually have a system for managing money. I get paid and it all gets allocated into different sub-accounts. So I get to save and spend. Any of my savings go into a higher interest savings account like you had mentioned. But it still feels frustrating, like it isn't enough.
Because you've become more aware. Most people don't notice inflation until life becomes painful. But once you start paying attention to money, you actually notice everything. Fuel, food, subscriptions. And when you realize prices are rising faster than your interest you earned, it can feel like the finish line keeps moving.
Humans like progress they can see. Fast progress feels rewarding. Slow progress feels invisible. That's why financial impatience is so common. Not because people are reckless, because people want reassurance that their effort is doing something. And parents feel this pressure heavily too, especially when they're trying to protect a family, trying to stay ahead of rising costs, trying to create stability. When prices keep climbing, even responsible people can start feeling anxious.
So what do people do then? Just leave money sitting in an account earning interest that is lower than the rate of inflation?
Well, banks don't pay interest to make you rich or to keep up with inflation. They pay just enough to convince you to keep your money there. Meanwhile, inflation keeps pushing prices higher. So even if your bank balance grows slightly, your money's buying power can still shrink. Imagine you save $10,000. A year later, the bank pays you $400 in interest. Sounds good. Until the cost of living jumps by $500 or $600. Your number got bigger, but your money got weaker. That's the trap. Savings accounts are designed more for safety and liquidity than real wealth growth. Over long periods, cash usually struggles to outrun inflation. If you want a higher rate, you can consider a term deposit, which I have done before.
Term deposits?
Yeah, basically, you agree to lock money away with a bank for a fixed period of time. And in return, the bank gives you a fixed interest rate. It is normally a rate higher than normal savings accounts.
Alex leaned forward immediately. A higher interest rate? Now this had his attention.
There are 3 important parts, though. The first is the fixed amount. You choose how much money you want to invest. The second is the fixed term. Then you choose how long it stays there. Maybe 6 months. Maybe 1 year. That's the fixed term. And the third detail is the interest rate. During that entire time of our investment, the interest rate stays fixed too. So, unlike some savings accounts, the rate doesn't change halfway through.
That sounds great. Why don't I just put everything into one?
There it was, the emotional swing. From frustration to wanting one big quick solution. That happens constantly with money. People feel pressure, then suddenly want to make aggressive moves to catch up.
You shouldn't put all your money in a term deposit. There's risk in locking away too much. I got burnt before.
I don't get what the problem is.
Say, you agreed to a 2-year fixed term, and you suddenly need your money early. You can't always just withdraw it like you do with a savings account. What happens is that there are penalties involved, depending on the term deposit you agreed to. Banks can reduce your interest or penalize you for breaking the term deposit early, because it's a contract, an agreement for you to leave the money there for the full term.
Alex's expression changed instantly, because now he imagined something going wrong. Unexpected expenses, a family emergency, something breaking. And suddenly the higher interest rate didn't feel as simple anymore.
So how do you know how much you can lock away?
You should consider your cash flow.
What does that mean?
Knowing what money needs you have in the future and taking note of it. I would normally suggest that you budget, but you had mentioned that you already have a system where you split your pay into sub-accounts, one for spending and another for savings. That gives you visibility already. I would look at my monthly cash flow first. Pay coming in, spending going out, emergency costs. At the end of each month, if you still have spare cash sitting in your spending account, it means you don't need to dip into your savings account to cover your costs each month. You might be able to invest your entire savings balance into a term deposit. As your savings is money you genuinely won't be needing for a while. Look, I was in your position before. I locked away all of my savings in a term deposit. I didn't look at my cash flow properly. Then Mom's 50th birthday came around and we wanted to buy her something really cool, and I didn't have the money for it. I had to break the term deposit and I lost like a chunk of interest. Most people get into trouble because they don't actually know where their money needs to go. So they commit too much, then panic later.
Alex sat scrolling through term deposits on his phone. Term, 6 months, 4.7%. Term, 1 year, 5.1%. Term, 3 years, 4.5%. He frowned.
Why are all the rates different? Shouldn't they all pay the same? Shouldn't the rate be higher if you are investing for longer?
Not necessarily. The rates change for each investment period based on what banks think will happen to interest rates over that period.
So, can you explain why the 1-year rate is higher than the 3-year rate?
If the bank thinks rates today are unusually high and probably won't last, banks don't want to commit to paying those high rates for too many years.
So they'd rather lock people in for shorter periods instead of paying high interest for a long time?
Exactly. That's why sometimes medium-term deposits can pay more than really long ones. So for 6 months, the bank is offering 4.7%. 1 year, 5.1%. 3 years, 4.5%. It is telling you that the bank is thinking that they expect interest rates to increase, but that it will eventually decrease, which is why they are offering you a lower rate for a longer term. They don't want to pay you a high rate when interest rates are lower.
So the term deposit rates are kind of a snapshot of what we expect future interest rates to look like.
Pretty much. They're heavily influenced by inflation expectations and competition between banks for deposits.
Okay, so how do I choose the best term then? I don't just choose based on the highest rate.
You match the term to your own situation first. If you lock your money away for too long, you lose options. Maybe rates rise later. Maybe you learn how to drive and want to buy a car. Maybe a better opportunity appears.
So the highest rate could actually cost me later.
A lot of adults fall into this trap too, especially parents trying to create security. Sometimes fear of falling behind makes people overcommit financially. Locking away too much, stretching too hard, trying to maximize every dollar. But financial plans need breathing room because life rarely stays predictable for long.
So good money management isn't just about chasing the highest rate.
Exactly. It's balancing growth with flexibility. The goal isn't to trap yourself chasing returns. The goal is building a system stable enough that you stay in control even when random things happen in life.
Term deposit rates, terms filled Alex's mind. 3 months, 1 year, 3 years, different choices, different interest rates. Earlier, they had just looked like random percentages. Now they felt connected to something much bigger. Interest rates, mortgages, rent, savings accounts, credit cards, businesses, all connected by the same thing, interest rates. One number changing somewhere. And suddenly, millions of people felt more pressure, and Alex didn't understand why. Alex realized money was not just about earning and spending, there was an entire system underneath it. And he had only just started seeing it.